Hi guys, in this video we are going to learn about where to invest, what are where to invest and what are these terms stands for, fixed income instrument or equity or real estate businesses or commodity type of investment. So the first thing you want to learn is when you want to earn something from the market, you have to learn something basic from the market. So uh, be focused. Let's learn a little more about this type of terms in this video. And the first one is goes with the fixed income instrument. A fixed income instrument is nothing but when a salaried employee who don't want to lose his money in the market, or don't want to risk his hard earned money, so he goes with he can choose this type of investments, fixed deposit that provided by the banks, FD, short term as FD, a fixed deposit provided by the banks, and bonds that are provided by the governments, and the bonds which are provided by the government sectors, and the bonds which are provided by the corporates. These are the types for the salaried employee. And um, and move towards the type, what are these bonds stand for. Bonds under the government sectors are as follows. First one is HUDCO. HUDCO is nothing but Housing and Urban Development Corporation Limited. And second one is NHAI. That's National Highway Authority of India. Bonds are nothing but bonds are nothing but in a company like this NHI and HUDCO. They take money from the investors. In exchange, the company promises to investor that they will pay interest, and they will return money to the investors on a set date. That's these are the bonds. And uh, and moves towards the and next is and the second one is equity is nothing but equity investment or equity trading is nothing but buying and selling of stocks through the stock exchanges, through the stock exchanges like NSE. NSE stands for National Stock Exchange, and the BSE, it stands for Bombay Stock Exchange. These are the two main important exchanges which is present in India, and these help to farm an Indian market. And this Indian market which has generated this Indian market means this inequity is it has generated a return up to 14 to 15% as a CAGR. 14 to 15% of CAGR over the past 15 year we are calculated. Over the past 15 year it generated a 14 to 15 percentage as a CAGR. And the third one is real estate. Real estate is nothing but buying and buying and selling of a commercial or the non-commercial lands. For example, transacting sites, transacting lands or apartments, or other transacting commercial buildings, or all are comes under the real estate businesses. And the next one is commodities. The commodity is nothing but the investor who invested his money in the precious metal. For example, the investor who invested in his money in gold or silver, etc. The investor can invest his money in the form of jewelry. The investor can invest his money in the form of jewelry, or the investor can go with the ETF. ETF is nothing but exchange trade fund, exchange trade fund. We will learn these topics in next videos. And let's Let's learn some key points from this video. A fixed income that has a lower the risk, which gives the which generates lower the returns, and the equity which has a quite higher the returns compared to the fixed income, and it also give the higher the returns, that's up to 14 to 15% of 14 to 15% of CAGR. So moral is nothing but when you take higher the risk, you will get the higher the return from the market. If you don't want to take any risk, then don't expect a higher return from the market. That's a simple rule that provided by the market. That's a simple rule we have to learn.